Day trading. Biggest scam I've ever seen.
Agreed.
Have you ever done any quick time trading? No.
I don't have the patience. I don't have the tolerance. And I don't want to pay the taxes if I win.
Wait, hang on. Why are you even qualified to talk about this? Why are you even qualified to talk about investing?
I used to be a financial advisor. Now, whether or not that qualifies me, that's in the eyes of the beholder. But I did a good amount of studying and learning about it. I practiced it for a while. I built a book of business. I had a number of clients that I ended up selling that business out. And knock on wood, during the time frame that I did it, I did see my clients actually making money.
Okay, so this is perfect because what I'll get often is, you're not a financial advisor. Like, why is what you're saying worth, your opinion, or why is it of value?
Well, you don't have to come from a point of authority to know what you're talking about.
Well, I agree, but this will be nice because now I have you. So we can test my ideas with a certified financial... Wait, are you still a certified financial planner?
Well, it's dormant for 5 years.
It's dormant.
I could turn it back on if I want to.
Okay, that's good. So this will be a good way for me to test my thoughts and then avoid anybody being able to say you don't know what you're talking about, because very clearly you do, right?
Okay.
All right. Why is day trading bad? Because what you're going to hear from others is, well, no, you just don't know what you're doing. If you know what you're doing, it's way better because you can make way more money.
All right. So statistically speaking, what percentage of the people would you say know what they're doing?
10%.
And that's about consistent with day trading.
Is it?
It's about 10% of the day traders actually make money day trading.
90% are losing money.
90% are losing money. So there's a survivorship bias that goes into it, where the attention is going to the small sample size within the greater scope of the people that are successful, and everybody thinks that they could just duplicate that. I would take it a step further, though, and say that even the 10% that are successful are only successful in a period of time. They're not over 40 or 50 years going to be winning consistently. They're just winning inside of that window of time that you're actually looking at. But again, even with that, you still have about 99 out of every 10 people that day trade are losing money.
Okay, so did you ever have clients that were like, Michael, I love that you're managing, my stocks, but I want to take more risk. And can I have a little bit of money for me to just play with?
Yeah. The great story on this one is I had a client who was an anesthesiologist. And so
they make money.
They make good money. And most of the time, he's not really doing anything. He's sitting in the operating room while the surgeon is doing the operation, and he's watching the machines, and he steps in if he has to. So what was he doing? He was reading news, reading financial news, learning how to day trade, learning how to do options, margins, you name it. He was learning all the lingo and kept calling me and saying, how come we're not doing this? I was like, look, if you want to do this, I'll tell you what. Let's take 10% of your total investable assets for the next year and do it.
10% of the year, not the whole portfolio.
No, I told him he can do 10% of the portfolio because he was pushing to do a big majority of it. So I had to negotiate with him.
Okay.
I told him I thought it was too much. I would have only done maybe 50 to 100 grand, but he wanted to do more. So I said, take 10% of the total portfolio and run it for a year and do what you want to do with it, because he thought he had learned all of it. And so he did. And for the first 3 months, he actually made money. And then he wanted to press. Fast forward to a year, he basically called and said, I don't want to touch this anymore. It's too stressful. And I ended up losing a ton of money. I had a margin call and I want out. Now, that was his scenario. That doesn't mean that that's everybody. But yes, you do come across clients who feel like they are able to learn everything that needs to be done and that they can play the game. But you have to understand, you're playing a game where it's a zero-sum game, meaning if you win, someone else is losing. And who you're competing against in that scenario are people with better technology, people that are much more well-versed and more capable of making decisions faster. You're not actually building and creating wealth long-term like you are investing in a company long-term or doing a piece of real estate. It's you are doing the trades where you're buying somebody's selling or you're selling somebody's buying.
Okay, so nowadays, like on the point about technology, right? every influencer you're seeing is they've got the huge screens and the trackers and the alerts. And what about those people that say, no, dude, like I'm using technology also. And, I'm actually using AI to hone in on my buy sell, and I have my alerts and triggers, and I'm holding to my discipline. And like, no, I'm leveraging technology just as good as the institutions.
I don't think that they are. Number one, they just don't have the power, right? I mean, whatever AI tool you're using, they're using a better one. Whatever tech you're using, theirs is better. They have more infrastructure than you do. You having 9 monitors spread across with all these charts, you're still one person doing the job, and you're having to compete against a firm that's got hundreds of people that are analyzing and making decisions. So will you win? Yes, you will win. Are you winning because you're doing it better than they are? I would argue that you're not. You're probably making a decision in a moment where timing is just on your side. And the problem with that is the dopamine rush that it gives you, right? It's just like your number hits on the roulette table, and all of a sudden you think you got the thing figured out. And so what do? You press. You push harder. And then you keep going, and eventually you're going to lose out, and the house is going to make money. And that's actually one of the biggest risk factors with the day trading world.
Yeah, I would actually argue that's the biggest reason to never day trade. And putting myself in that place, I love dopamine. I freaking love the rush I get, right? And if I'm like wound up because I'm looking at a quick risk and then I hit, I could see how that would just become gambling for me. And it was just feed it, win, win, win. That's a dangerous place to be for investing. Well, let me ask you this. Should investing feel good? And should you feel that rush when you're investing? Or should investing feel very boring?
It should feel very boring, to the point where it's like you're not really looking at. So remove the investing side of it, right? Let's temporarily not talk about the day traders. Let's talk about the doctor, the anesthesiologist who has a full-time job. You have a skill that makes you a lot of money, which is your medical profession. Your investing strategy should be secondary, something that you very seldomly look at. You should look at it, but I always say it's like a bar of soap. The more times you wash your hands and the more times you check your investment portfolio, the less soap you're going to have over time, because you're going to become significantly more susceptible to making emotional reactionary decisions, right? You're just going to be constantly responding in a reactive way. And so when you do that, you are opening yourself up to making a mistake.
So you brought up margin calls, and will you explain the different ways to use leverage when buying stocks? Or will you kind of build that out? Why would you get squeezed and get called on your position?
All right. So in real estate, we use leverage in order to increase our buying power, right? If we have a $200,000, we can buy a $200,000 asset all cash, or we can buy $1 million asset by leveraging it up, right? That means somebody's lending us money to do it. The margins in the stock market work the same way. You are borrowing from the broker money in order to go out and to buy whatever it is, that's whether it's you're going long or short on a position in the stock market.
Okay.
So that increases your buying power, let's say by 4x. Because like the easy math is, if you put $25,000 on deposit with the broker, you'll typically get $100,000 margin allocation.
Okay.
So now you are buying and selling with $100,000 worth of money.
And your margin is 25%?
Yeah. Well, your cash on hand is 25% with the broker, and that gave you the $100,000. So you're 4x on your leverage ratio.
Okay.
So now if you make a 1% error, or let's say a 1 to 2% error in your trading, you've now exacerbated it by 8%, right? Because now it's an 8% move because you have the margin portion of it, right? And the inverse is true too. For those that are saying, yeah, but if you make it, you make 8 times as much. Yeah, that's true. You're just expanding the impact by using leverage to do it. So leverage is a tool, but it's a tool that can get abused very quickly.
Okay, so when do you run the risk of having it called?
If you lose money, if you did it with $25,000 in cash and you went down, you would go down, and you can control if you sell or if you're going to hold it and wait it out to see if it comes back up. When you use margin, if it goes down, the brokerage house can say we're calling it, and now we're selling the position. You have no control over it.
They can call it at any point
can call
if
it
it just
any
goes
point.
down. So if it goes down, let's say you bought $100,000 worth of stocks, and it's now worth $95,000. They can call it.
They can.
Or does it have to get to a certain point?
If it reaches a certain threshold, and all the margin agreements are going to be different. If it reaches a certain threshold, they have the ability to liquidate your position without even you stopping it from happening.
Okay, and if they liquidate, how much do you lose?
It depends on how much you went down.
Let's say, okay, is there a scenario where you can go past your position? So like if you borrowed $75,000, you put your $25,000 down. Is there a scenario where you can lose more than $25,000?
Possibly, if they'll let you go beneath that threshold.
Okay.
It just depends on what the brokerage house is working with.
So what about this scenario? You've got somebody who sees something in the news. Let's bring it to today, tariffs, right? And they see some volatility. They're not necessarily a day trader, but they're like, oh my gosh, like I listened to Bill Ackman. Bill Ackman says that the Trump administration is going to put a pause. If they put a pause, the market's going to go bananas. I'm going to buy into the stock market now. Is that, do you think, considered day trading, or is that just bad investing? Like, what qualifies you to be a day trader versus a bad investor?
Well, bad investors can be day traders, but not all day traders necessarily are bad investors, right? We talked about like 10% of them do win. Now, a bad investor is, regardless of whether or not you're a day trader, is somebody who's letting emotions dictate their decisions. So if you are hearing the news on the tariffs and seeing Bill Ackman and all these other people saying things are going to go nuts right now in the stock market the moment he hits pause, I'm going to buy. You're making a decision more based on emotion than you are on fundamentals, right? The inverse is true on the positions that you hold. If you're holding a position, I had a client that did this. He had a lot of Facebook stock. And I mean, I want to say when he came to me, it was like 60% of his total portfolio was in Facebook. And the moment he started with me, I was like, dude, where did you buy it? Where's it at today? He was up significantly. We need to sell. And his response was, there's absolutely no way. It's going to keep going up. It's, to the moon. And I was like, not to the moon. You need to rebalance your portfolio. And he didn't want to do it because he was very greedy and he felt like he knew more than what the markets were saying. And so he held on to it. Fast forward to COVID. COVID hit. It tanked in March. I think Facebook went from, I want to say maybe like 80 down to like 30. I don't know the numbers off the top of my head, but it was a significant temporary dip. He called me, full-blown panic. I'm selling everything. It's like, now? You're down. You're not out. Now's not the time to sell. So the emotion of reacting to news and the emotion of the greed and the fear element is what makes investors make bad decisions. And that's the thing that a lot of people have to avoid. And day traders are prone for being very emotional with what it is that they're doing because they're glued to those 9 monitors and they're just constantly seeing things and reacting to it. Some of their reactions are going to work in their favor, but again, the majority of them are not.
Okay, so if you're, this is going to go a little bit beyond day trading, but if you're an emotional person, should you even be managing your portfolio yourself, even if you're long, you're not day trading? Like, is there a correlation between the importance of a high emotional person and having an advisor?
There should be.
There should be.
Yeah, if you feel like you cannot maintain a good discipline on the buy and sell side of investment, you need that person that will talk you off the ledge when your natural inclination is to execute a trade. Right? Like you're going to have to, and a lot of people would call me for this reason. The Facebook guy called me. I want to sell everything. No, you're not selling everything. Now is not the time to do it. Had he sold, he would have missed the upswing that took place 3 months later, because remember in COVID, we saw a V-shape basically response. So he would have missed the upswing. Now, here's the funny part of it. The upswing happens. I call him and I'm like, dude, aren't you glad we didn't sell? He's like, yeah. I'm like, now we should. Nope. Why? Because it's going to keep going up. It was like, and I had to fire him as a client. Like I couldn't keep him because I was giving him advice that he wasn't actually following. And now I'm liable to a certain extent for it. And so you have to be very honest with yourself to say, I cannot control my fear and greed, natural inclinations when it comes to my money. I need to be very diligent in hiring the right person that I'm going to work with. But the moment I hire them, I'm going to have to use that resource to help me avoid making mistakes.